Hey, what's up, good people? How you doing? My name is Larry Jones. For those of you that are new to the page, let me do this. Hey, go ahead and do like the prompter tells you to do. Hit the like, subscribe, notification bell. You guys know what to do. Hit the like early. It helps the page. You guys know not to fall for spam already in the comment section. You already know that. You also already know that anything that I say is not a suggestion for you to buy, hold, or sell, but we're going to be discussing the market, and I believe that every investor needs to know this, especially if you're new to the market and have been trading under 5 years. Okay, so I'm going to start by saying this: the market does not want to pay these high multiples, right? The market does not want to pay high multiples. If you got in the stock market early, should I say early 2021 or late 2020, okay, and you got in during that bull run, the market really didn't care about multiples, meaning high price to earnings, right? And they didn't really care about the expensive stock. Stock were just grossly just overvalued, okay? I'm going to do another video and I'm going to look at all of these companies that had these ridiculously high IPOs, right? And the multiples were ridiculous. They were too expensive from the start with the IPO. And now some of them are beat down. A lot of them are beat down like more than 50%. I made a bunch of videos saying never buy an IPO on an overhyped stock. So the market is punishing every stock that is expensive. Just think about that. What I want you to do is to go into your portfolio and see what stock has them high multiples, because those are the ones that have the potential to take a spanking during a recession or even during this bear market. Okay, so we got a lot of things to cover. Let's get right into it. I just wanted to start off by saying that because I wanted to get that in the way. All right, so let's go here. Sorry, good people, I was eating, trying to run and get this done too. All right, so let's look at what's happening. I'm gonna do a lot of reading. I'm gonna be trying to go through this really quick. Take a pen and paper out and take some information down because this is important for you to know. At the time of recording this, there's 30 minutes before closing bell. As you can see, everything that the Dow gave yesterday, which was 600 and something, it has taken that back and more. It's Friday in this bear market. We know that the sell-off is generally the last half hour, so no telling where this will close, but it will be negative. Everything else, S&P, NASDAQ, Russell, everything is doing the Friday sell-off, right? Why? So there's something very important that happened yesterday, and the market just wasn't paying any attention to it, but now it is. And that is this, good people. This is it. Economists contract for the first time since 2020, right? Contracts in its first quarter as GDP falls 1.4%. Gross domestic product, right? Let's see what that means. Gross domestic product. GDP measures the monetary value of final goods and services that it is. Those that are bought by the final user, that's you and I, produced in a country in a given period of time. All right. So you see that, right? That's what GDP is. Okay. So we also know that it fell 1.4%. That's a problem, good people. GDP is supposed to be growing and not falling. And when you have GDP falling and inflation rising, then that's a serious problem. That means you're not just paying more for goods and services, right? So it's like goods and services are running up, but your pay is not going up. So if your pay was going up, what you earn is going up, and gross domestic, which is gross domestic product, and inflation is going up at the same time, then that's fair. But if inflation is going up and what we're spending money on is not, and what we're making to spend money on it is not going up, it's not a good correlation, then we're losing doubly, if that's a word. you're losing doubly. I'm going to make that a word right now. Okay. And so therein lies the problem. And we are purchasing less goods. So we're not purchasing at the same amount. Me personally, I'm not a genius, but I expected this to happen because when the Fed raises interest rate, people start to pull back, okay? And then the price of something can only go so high before you and I say, I'm not paying that. And we start to pull back. And that's what's happening. But what happens is there's generally GDP growth, and now it's not, right? And so you hear a lot about stagflation. That's what stagflation, we're heading towards that period, and not peak inflation where it'll turn around, peak, and then turn around and come down, but stagflation. And we could get caught in that where GDP is not growing, but inflation is growing. And so that's not good for the overall economy. Let's keep it going. So let's look here. This is some historical data. Let's go back to the last recession. See, here's the recession timeline. December 2007, I remember this one well, through June 2009. Look at this. Look at this. A year and 6 months. That's the length of the recession, right? The one before that was 8, a year and 4 months, 6, a year and 4 months, 11, 10, 11, 8. So I'll just let you know overall, the average length of a recession is around 11 months. We don't know how long this one is going to be, but we are not going to be scared. We're going to be prepared, right? So remember, I kept talking about the Fed, right? We have 2 more FOMC meetings, and here they are. I want you guys to write this down. So May, it's May 3rd and 4th because it's 2 days. The meeting always lasts 2 days, right? So May 3rd and 4th, and then June 14 and 15. Now, me personally, myself, Larry, I believe that this will be the most volatile that the market will be, because we're probably going to have 50 basis points here, and we could have 50 basis points here, because the Fed has to get this inflation under control. Now, so what happens during a recession? The Fed usually reverses that. I told you guys that before. They usually start coming down. But now we're caught where the Fed has a job. There comes a time when the Fed, regardless of what they do, it's almost impossible to land the plane safely. It's almost impossible. Hell up a tree, hell on the ground, like the old folk used to say. And so that's what's happening. So now I want you guys to write this down. Within the next 6 weeks, so let's start from the 1st of May. So within the next 6 weeks, I believe, this is me, these are not facts, and this is not data. This is Larry Jones. I think that the most volatility we'll see this year will be in the next 6 months, starting now, right? And then what happens is the market starts to price things in, all right? Now let's look at this. Performance of the S&P during and after recessions, okay? Here it is. In the last 11 recessions, you see this. The average length is 10.3 months. So just like I said around 11 months. Let's just say about 11 months, okay? And different things causes recessions, right? Last recession was from the banking, the housing bubble, right? And so that's one of the lagging indicators that we haven't hit yet. Job loss and housing. But there is a housing bubble. There's a lot of realtors out there going, oh no, this is going to run. It's not. It's a housing bubble, and it will pop. They always do, okay? And now, no one knows how much, but it is. It's going to pop, all right? So let's look at this. Look at this. I want you guys to read this, though. This is why we're not scared. We're prepared. Read that. After recessions, it should not come as a surprise that the cumulative returns grow increasingly positive the further out you go after a recession. After all, stocks tend to go up more than down. And the longer you stay invested, the less likely you are to lose money. The instances of positive returns almost double. You guys see that? I want you to look at this and read it again. This is on Forbes, and I want you to read this. This is why we are not scared. We are prepared. So in all of the hysteria and all of the fear and everything that's going on, recession, I always want you to keep this in mind. That's why we're going to do what? We're going to DCA, dollar cost average, right? Remember, on days like these, as soon as I finish with this video, uploading it, I'm going to my portfolio and I'm going to buy. Always buy Friday, the last half hour. You can buy when you want to, whatever your dollar cost averaging in. And you say, hey, should we continue to dollar cost average? And there's a looming recession. Absolutely. That's the point. That is the one thing that you could safely do during any market. You know, you can't always swing trade or day trade in any market. Sometimes it's high risk, right? But the one thing you can do through any market is continue to DCA. And if you're following the family, we are minimum 5 to 10 years. So I'm minimum 10 years. Some of you guys will be minimum 5 years. But remember, you just read this, good people. We just read this. This is important. Remember, we just read this. Remember, stocks tend to go up more than down, and the longer you stay invested, the less likely you are to lose money. The instance of positive returns almost what? Double. All right. So let's keep it going. We see that, right? So what else? S&P. Now, I want you guys to watch this because some of the plays that we're in now. So after all of this has been said, the market could still hit a new high before the recession comes. But be not fooled, because you can have a rug pull. Some of the stock that are actually performing good pre-rug pull or pre-recession are some of the ones that will perform the worst during the recession. So take a look at this, good people, right here. Look at your worst performers. The S&P will get hammered. So let's start from the bottom. Consumer discretionary. Look at that, down 4.5%. Real estate, 3.8%. All right. Information technology, financials. Look at that. Even financials tanking almost 3%. Okay. Now these numbers are not going to be exact. They're going to change from recession to recession, and some will just be flat. Some will beat down already. And actually, what is this? Keep in mind, watch, let's read this. I hope this is the right one. Okay. Read this. Keep in mind, most of these stock market pain, keep in mind, much of the stock market pain comes 3 to 6 months prior to the start of the recession. Remember, prior, okay? All right, investors anticipate recession. You could read the rest of that, all right? So just remember, some of this pain comes, sorry about that, good people. Some of this pain comes before the recession. So you saw that. 3 to 6 months before the recession, some of these negative downturns here comes before, right? And so that's why some people are asking, are we in a recession right now? And the fact of the matter is, no one knows. And I've been asked, and I tend to say no, because there's some things that are happening that is yet to happen. But the truth be told, 100%, I don't know. No one knows, because most of the times you don't know you're actually in a recession until 6 to 8 months after you're already in a recession. So having said that, some of these stocks could be near recession lows already. But some of these stocks will continue to fall like a knife and get beat down. So, having said all of that, remember, you can rewind this and go back. I'm saying, me personally, I'm not loading up on any one stock. I'm just going to continue to dollar cost average. And if you're not doing that, I prepared 3 portfolios for you guys. I'll leave the link of the list here again because it's important for us to build what? Generational wealth. And in it, we have ETFs, right? What else we have? We have growth stock and we have blue chips. And so we got all different sectors in there. And so the stock that are going to double in multiples are in there. And some of those are just, the indexes, right? And so it's going to perform like the market does, right? And I just got a array of them. You pick any ones you want. If you got $5, $10, $20, $50 a day to invest from now until 5 years from now, as a matter of fact, go back to the beginning of the year and just count your days and do $5 a day. You could take 4 different stocks. Take your $5 a day, divide it between the 4 different stocks and just buy them monthly. All right. I'm going to leave it right there, good people. But there's a lot of good information in here. I want you guys to remember this for the next 6 weeks. Okay. Because this is to me, this is very important for us to keep these dates right here. This is what we want to keep in mind. These next 2 Fed meetings. Okay. And so it doesn't come as a surprise when it does come. Right? So until then, good people, hey, make sure you check out the links. Now, here's what we're doing. We know that most of you already got the Webull. And if you don't, download it right now. I'm going to tell you what we're doing with it. Most of you already have a Webull account. But for those of you that don't, download Webull right now. Just put $100 in. Yes, they have a promotion. Put 1 penny in and they're going to give you 5 free stock worth up to $9,600. So we know that. So just start with a penny if you just don't have any money. But if you do, for those of you that already have it, I know there's a lot of red in there. Anybody that's in the stock market got some red in their portfolio. If you don't have any red in your portfolio, you're a freaking genius. All right. Or you just got 1 stock. Let's just call it, you guys know I keep it real. But what we're also doing now, for those of you that's doing $5 a day, I'm going to challenge you to do $10 a day. But the other $5, I want you to put it into Moomoo. Open up that Moomoo account, click my link below, and they're going to give you up to 6 free stock worth up to $3,500 per stock. That's Moomoo. And what we're doing with that money is we're just cashing up. We're cashing up. That's what we're doing. We're just cashing up. The sooner you do that, the better. And I want you to start to put money into both, because we're going to be swing trading stock and crypto with Webull, right? And then with Moomoo, that's when we're going to start buying after we know that we're in a recession, when we're sure. So we're not scared, we're prepared, but I have to give you guys the full story of everything that's going on, all right? I'm going to leave it right there. Sorry I had to keep it moving, but I just wanted to get in a lot. Have a blessed and wonderful weekend. Live, love, laugh, and learn. I love and appreciate each and every one of you.